All right, folks, welcome to Investing for Beginners podcast. Today we have episode 362. Today, Andrew and I are going to discuss something related to valuation. It's called CAP, or competitive advantage period. And this is a term, I'm not sure if Michael Mauboussin originated it, but I associate it with him and his writings. So with that, we're going to go ahead and just kind of dive into the topic, and then we'll just see where it takes us. So Andrew, do you want to maybe kind of give everybody maybe a 30,000 foot view of what a CAP is, or a competitive advantage period might be?
Yeah, I'm happy to. So you have businesses, you have the economy, you have a bunch of average businesses, and then you have the select few businesses that are so good at what they do, so able to make profits, so able to grow that they create what's called excess returns, or basically just returns and growth that's higher than the average. In order to do that, for a long time sustainably, you usually need some sort of competitive advantage to do that. And the competitive advantage, or the moat, helps you to sustain that. And so for every business and in every industry, that's going to look different. And maybe a lot of businesses in certain industries don't even have one, you could argue. But for a few really outstanding businesses, they have this competitive advantage period, which is a period of time where they are able to whoop on the market because they have a moat. And that's what competitive advantage period is, as far as I understand it. I'm no expert, but I have read at least one of Mobuson's writings about the cap. And so that's my understanding of it. And with that kind of as a backdrop, why is it important, or how does it explain certain market behaviors, if you will?
Yeah, the interesting thing about it is I think it helps to me, it helps explain why those certain businesses that you're referring to tend to have higher valuations for longer periods of time. And you can think about, throw out some usual suspects that kind of fit into this realm, if you will. Companies like Visa, MasterCard, Costco, Hermes, Porsche are just some of the ones that just kind of come to mind naturally. You never, ever, ever, not never, ever, you rarely see them trade for low multiples, low PEs. A PE of 15 for any of those companies we just mentioned is unheard of. And so when you think about a competitive advantage period, it makes sense because the way we normally, air quote, value companies is using something like a DCF, or a discounted cash flow model. And generally with those, you project 5 or 10 years of cash flows and then discount them back to the present day and value the company based on all those machinations. The problem is that when you're looking at a company like MasterCard, who has developed this very strong moat, a very strong brand, a not unbeatable company, no company is unbeatable, but just a very strong competitive business, using a 10-year period is too short. And so the competitive advantage period is a way of extending that valuation model to give you an idea of what really the company is worth, because you're not, it can't just be limited on a 10-year period. Now, none of us can see 10 years into the future, and trying to look 17 years into the future, just for example, seems even more particularly daunting. And it's not easy, but it's, to me, it's more about a thought exercise about how you use the valuation model and how you think about looking at a value of a company like a MasterCard compared to competitors, PayPal or something along those lines. The moat is way bigger for MasterCard than it is for other companies in their industry. Discover, for example, it's way bigger than Discover's. And so you have to value them differently. Even though they're in the same industry, you can't value Amazon the same way you value Walmart. And so it's, or Costco and Walmart, they're not the same businesses, even though they are, big box grocery, stores, they're different. And we all know that intuitively, but when you value them, I think you have to look at the value of them, of them longer. So I guess when you're thinking about this kind of thing, I like to think about not only the moat, but also how wide that moat is, and is the moat growing? And what are your thoughts on that?
I think it's always important to consider moat and consider whether it's growing or decaying. Some, again, a very select few types of businesses have moats that, as part of the secret of the moat, is the automatic strengthening of it. It's a virtuous cycle. So Nick Sleep talked about this when I don't know if he was the first person to explain this idea, but he definitely popularized it, probably one of the first people to. This idea of scale economy shared. So scale economy shared is a type of moat that gets stronger the longer it lasts, really. And to give you like a long story short, it's basically, if the moat is from scale, which means as a company gets bigger, it gets a stronger moat, like a Costco you mentioned, then in Costco's case, they share the benefits of their scale with their customers. And so the bigger Costco gets, the more valuable they become to the customers. And the more money the customers give to them, and then the more valuable they become to the customers. So you see how it's a self reinforcing loop. Now, you can say scale advantages, and you could say lots of businesses have scale advantages, but that's not the same thing because it's not self reinforcing. There's not a loop that builds on itself. And so that would be the difference. But when I think of how do you find moats that are widening, that's that's such a hard thing to do because,
Mhm.
like you said, who has a crystal ball, who can see the future 10 years, let alone 1 year out. But there are a few businesses, and we can debate any business going down the list whether that's the case for them or not, but there are a few that actually do get stronger. And so it becomes more of a question of, is something terrible going to happen to this business, which it can for any, which is why you diversify your investments. But if that's the question versus, a million other questions that you have to ask yourself whether a moat is going to strengthen or not, the easier one, the easier decision, and one that's more likely to be long lasting, is one where it's already ingrained in it and it has that virtuous cycle.
Mhm.
Those are kind of my thoughts on widening moats. Do you have other things that you think of when you hear the widening moat idea?
Yeah, I think of how do you measure that, and I don't know that you can. And
Mm,
like, is there any quantitative way that you can measure Mastercard's moat is widening? And I don't know that there's a way. There's some subtle ways that maybe you could see if the company's margins are expanding, or if their revenue growth is maybe accelerating. Maybe some of those things might give you an indication that they're widening their moat, or they're capturing more market share from their competitors. And so those things could give you some clues. But I think, to your point of what Nick Sleep was talking about, when I think about Visa and MasterCard, maybe through the lens of what he was talking about, it's not exactly the same, but the idea that the businesses are getting better just helps strengthen the moats for those businesses. And if I think about MasterCard and Visa, for example, those companies are working towards not necessarily pivoting, but adding additional revenue streams to what is already the core part of their business, in the anticipation that those other parts of the business become a bigger part share of how those companies continue to grow. And to me, that indicates that the core business already really strong, but they also have opportunities, or optionality, I guess, to not pivot, but to move into other things that can be maybe ancillary, but also complementary to what they're doing. And it also indicates to me that because of their openness and willingness to work with competitors directly, i.e., Ajin, Bitcoin, PayPal, all these other companies, being willing and able to work with them also helps to me strengthen their moat, because those are the people that in theory could try to compete away some of what MasterCard and or Visa are trying to do and take some market share with them. But because MasterCard and Visa are aggressively open about working with other companies or other systems like Bitcoin, then that to me helps reduce the threat of disruption or somebody coming in and undermining what it is that they do. And until there is some sort of new payment rail that kind of encompasses everything, I don't know that there's something that's on the horizon that could disrupt those companies. And to me, that just gives them more strength for their moat. And it also means that their competitive advantage period is going to be longer than somebody else in the payment space, because those other companies, I'll throw out a couple that have been kind of the rage on FinTwit recently, Wise and Remitly. These are companies that do a lot of cross-border payments and moving money around different parts of the world and whatnot. And I don't know either one of them as intimately as I do Visa, but I also know that that's something that Visa competes in. And if you're going to value what Visa is doing or is attempting to do, kind of comparatively to those other two companies, I would put a longer growth period or a longer period on that being a valuable resource for Visa than I would the other two companies. I don't know that they'll be as successful over as long a period as Visa could be. And so when you're thinking about valuing the company, I would give a lot more value for a longer period of time to Visa because of that and all the other things that they do than I would for something like Wise Remitly. I'm not saying those are bad investments. I'm just saying that when you value them, I would look at them completely differently. Does that make sense?
Yeah, for sure. Do you think this is a loaded question, I guess, because every situation is different, obviously, but do you think the market generally behaves that way too? Or do you think other things get bid up? Does it just depend on what industry we're talking about?
Yeah, it can depend. I mean, I think there's certainly things. If you look at Wise and Remitly, I think people are undervaluing the value of their cash flows. Whereas I think with Visa and MasterCard, they're assigning a higher price to their value because it's a longer period of value and it's going to be more valuable longer. Whereas Wise and Remitly they've both been around for 5-10 years, but they're also still early in the journey in what they're doing. And there's no guarantee that Visa at some point may outdo both of them. And that could be a very big thing for them and MasterCard. And what Wise and Remitly are doing could be competed away and very easily. And so I think that the market is actually probably thinking that that's what's going on, because if you look at the financials, if you look at the revenue growth for Wise, for example, it's ridiculous, 60-70%, crazy numbers, but the market is not valuing it very much. It's not valuing it very highly. It's a lower rated company, if you will. And I think a lot of it is because there's a lot of uncertainty that can they really continue to compete in the space when Visa and MasterCard, the juggernauts, are there and are capable of doing what they're doing as easily if they choose to do it.
A lot of times that's kind of what it comes down to, right? When you have these differences in valuation, people are going to say different things, but a lot of it can come down to if you're talking to, let's be clear, if you're talking to long term investors who are looking to buy and hold something and compound it and just sit there and do nothing, the differences in valuation are maybe more differences on how long do people expect a competitive advantage to last for a certain company.
Yeah. I mean, we were talking earlier on our valuation hackathon about O'Reilly. And I think if you think about how the market is treating that company, or a way a lot of investors think about that company, is that the EV revolution is going to be ultimately is going to be the death knell for a company like O'Reilly or AutoZone. And I think because of that, investors look at their potential competitive advantage period as a lot shorter than they would a company like Tesla, for example. Tesla is, I think we would all agree, is a unique case because, of who drives the bus at that company. And so he engenders a lot of, well, good and bad tension. And there is definitely some enthusiasm baked into the value of that company, but it's unquestionably that they've done a fantastic job doing what they do. But are they really going to come eat the lunch, of some at some point of an AutoZone? I don't know. We could probably argue about that from now until the end of time. But I think the market, when they look at AutoZone and O'Reilly, I think they look at them as like, not that they're bad companies, but they're like dead men walking because disruption's coming for them. It's just a matter of when.
based on low multiple.
Mm-hmm.
All right. Do you think there are ways the cap idea is taken too far where people kind of run with it? And have you seen examples of that where people kind of run with the cap idea?
Yeah. Yeah, for
What,
sure.
what is that?
I think the way you can look at it is there's a couple ways you can look at it. So, number one, when you're normally doing evaluation of a company, you want to estimate the terminal growth rate at roughly the GDP or somewhere in that range. Anything above the growth rate of the GDP, if you do it to infinity, then that's not that's not logical. It's not reasonable. It can't happen because of just the nature of compounding. And I remember a story that Professor Demoterin talked about where he had students turn in valuations, and student turned in a valuation with Tesla, and their terminal rate, which is normally 2 to 5%, give or take, he had put it 8%. And so the value of the company, he was projecting basically that in a 20-year period that Tesla would be larger than the GDP of the United States. And if you went another 10 years, it would be larger than the GDP of the world. And so everything that everybody did would have to be bought from Tesla and nothing else. And obviously that's not reasonable. And no matter how much you drink the Kool-Aid, that's not reasonable for any company, and even Costco. I guess the point is that when you think about those things, you have to think about it has to be you have to be logical and try to be reasonable about that. And so when you're thinking about the competitive advantage period, the enthusiasm you have about a business has to be built into some sort of realities of history of business, how long companies have been in business, how long they can stay on top. You would be surprised how short that really can be. I don't have the numbers in front of me, and I'm not recalling them, and maybe Andrew can fill in if he remembers. But the amount of time a company spends in the S&P 500 as a member is not very long. I think it's less than 10 years. And if you look back on the last 20 or 30 years of like the top 10 companies, I know Buffett showed this at a shareholder meeting recently. If you look at the last 20 or 30 years, the amount of companies that have stayed in that top 10 of the S&P is two, Apple and Microsoft. The rest of them have all fluctuated in and out. There's been the Ciscos, and then there's been the Exxons and the companies like that, and then now we have Apple and Microsoft and Nvidia. But those a lot of these companies are new to the S&P 500, new to the top. Meta is new, Nvidia is new, Tesla is new, Berkshire Hathaway is new. They've been around for 60 years, but this is a new thing for them. And so my point with all that is that when you're trying to value a company and you're looking at this idea of extending your valuation because you think their competitive advantage is going to be a lot longer than a 10-year period, it may very well be, but it can't be 40 years. Just because that's just it's not logical, it's not sustainable. And if it is, it's going to be one unicorn company, one, and not 10 of them. One unicorn company that could possibly do that. And there's always outliers when you're thinking about valuing companies. And you have to try to be as reasonable as you possibly can. And the thing that I like about the competitive advantage period is it helps explain maybe why a company like a Costco or a MasterCard seems like it's always expensive. And it's because it is, because the value that the company is creating is a longer period than its normal brethren in the 10-year range. And so that makes sense logically. But the hard part about it is that there is no rule or hard fast number that you can apply to it. It takes some intuition, and it also takes some knowledge of the business and the history of the company and the industry they work in to kind of extend those numbers to give you a range of what you think the value could be. And it's not easy, and it's not hard, and you can't apply it to every single company, because the simple fact of the matter is that companies rise, companies fall, and they go out of business. And it happens to all of them. If you looked at 30 years ago and you asked our grandparents or our parents, do you think GE would be not the dominant business that it is today? Nobody would have said yes. I mean, and look at it now. It's a shell of itself. And it used to be one of the most dominant businesses in the United States, and now it's a shell. And we look at Microsoft and Apple and think that's never going to happen to them, but it could. It probably will at some point. We don't want it to, but that's just the reality of investing. Is nothing stays the same forever.
Vitaly Katsanelson did a email that he did recently. It was a article he wrote. I think he said it was one of the first ones he ever wrote. It was like 1994 or something. And he was talking about the danger of I don't know if he called it or somebody else called it, like religion stocks.
Yeah, religion stocks. Yeah.
Oh, you read this?
Yeah.
It was fascinating. He brought up Coca-Cola, and really with the presence of any of these religion stocks, they become religion stocks because they make people a bunch of money.
Mm-hmm.
And then so because the stock's been so good for so long, it gets this cult type following. Use Coca-Cola as an example. Or no, I guess he wrote this in 2004. So it was 20 years ago, not 30. My bad. Looking at Coca-Cola, and at the time in 1999, the PE got to something like a 45. And the 10-year growth rate of earnings at the time was 14.2%. So you would look at that and you would say, why wouldn't they continue? They've had like amazing CEO, earnings growth at 14% a year for 10 years. Like, what's not to love? And you fast forward just 5 years later, and then even looking back in hindsight today, it hasn't been, I mean, yeah, the relative strength between Coca-Cola and Pepsi and say Dr. Pepper, it's still there. But I guess the thing that frame didn't think of is maybe people becoming more health conscious or something. So a disruption, if you will, that came out of left field, that maybe Coke's moat didn't get weaker against its competitors, but something else came. Customers' preferences changed. And it just goes to show that idea of a cap and the limitedness of it is a very uncomfortable thing to have to deal with as an investor.
It is.
But if we were to respect history, then we'll know that it's something to watch out for.
Yes. Yeah, exactly. I mean, you really have to understand the history of the markets and understand the history of the businesses. And to your point about Coca-Cola, it doesn't last forever. And you just have to, as much as it sucks to take some of those things into account, you have to. And you have to realize that when you're trying to figure out why does the market think this is so, worth so much, and it really comes down to, I think that the market looks at Walmart and they look at Costco and they think the dollar of earnings that Costco generates is more valuable than the earnings that Walmart generates. It doesn't mean that one's a better investment or another necessarily, but it just means that the market thinks that those earnings are more expensive. And it's like going to buy a car. I used this example earlier. When you go buy a car, you buy a Tesla and you buy a BMW, both luxury vehicles. If you pay $70K for a Tesla and you pay $50K for a BMW, that means you think that the value of the car for Tesla is worth more to you than it is buying the BMW. And they're both luxury vehicles. They're both great cars. They both could be electric for that matter. But you pay more for the other one because you think that's more valuable to you. And that's why when I look at these companies that are higher priced, that's the way I interpret it, is that the market looks at them and thinks that dollar of value they generate is more valuable, and it's going to be more valuable for a longer period of time than a competitor. And that's kind of how I try to look at it.
So, how does an investor deal with the uncomfortableness of the cap and the fragility of a cap?
That's a good question. And that's one of the hard parts of investing, right? Is dealing with the uncomfortableness. I think the way I try to do it is by spending a lot of time thinking about the moat and competitors of the business, and trying to maybe not necessarily invert per se, but certainly think of worst case scenarios, like stress tests. What could how could this go wrong? You were talking about Coca-Cola earlier. What's not to love? 14%, earnings growth. That's awesome. Especially for a business like Coke. It's not a high tech business. So you think about companies today that we're talking about some of these special businesses. That's what I think about. Is I think about, okay, what could unseat Costco? What could unseat Visa? What could go wrong with this investment, and how likely do I think that is? And I think the more that I get to know the businesses and the business models and understand them better, and the competitors, then I think that really helps me understand why the market is valuing Visa's dollar more than somebody else's, and why I think that'll be a longer period of valuation than others. What
That's
are
a
your
good
thoughts on
answer.
that?
Yeah, I think it's a good answer.
Okay. All right, folks. Well, with that, we'll wrap up our conversation on CAP, or competitive advantage period. I hope you enjoyed our conversation today. If you're unfamiliar with this term, go check out Michael Mobison's paper. He wrote about this extensively. You can just type in competitive advantage period and Michael Mobison, and you will discover it on the miracle that Google is. Also, he also writes about it in his book, Expectations Investing, as well. So those are two good resources beyond Andrew's and I's conversation today. It can be really helpful when you're valuing companies and trying to just think more deeply about the businesses that you own or want to own. And so with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.